What's up, moneymakers? Vincent Chan here, and in today's video we're talking about my expectations for GameStop's infinity squeeze this week and beyond. And the only thing I ask of you in return is to hit that like button, and if you are new here, welcome to the moneymakers family. Make sure you smash the subscribe and ring the notification bell. Firstly, let's recap some of the highlights for last week because there's a lot of misinterpretation going around. And I want to start off by reading a hilarious tweet from Steve Cohen, who is the owner of the New York Mets as well as the owner of the .72 hedge fund that recently bailed out Melvin Capital. And if you don't know what happened, check out this video over here. Essentially, in response to someone in Barstool Sports, he says, "Hey Dave, what's your beef with me? I'm just trying to make a living just like you. Happy to take this offline." And keep in mind, Steve Cohen has a net worth of over $14 billion. I thought it was hilarious because he's probably wondering which of his 70 yachts he should be selling in order to continue paying for his country club membership. So this is the reality that we're living in right now, the disconnect between the 1% and the rest of the people, on him trying to make a living as a $14 billion net worth individual. But on a more serious note, we've actually seen a lot of movement from institutions trying to scare off retail investors, either trying to get the price down from doing a ladder attack, where essentially hedge funds just put in lower and lower bid price amongst themselves, and even though there's no volume between the trades, it does look like the stock price is going down, as well as doing a thing called price cliffing, where they try to drive the price up in order to get some retail investors to lock in some profits and sell their shares, as well as a lot of press release sponsored for that matter in trying to promote the post that Melvin Capital exited out all their short positions, as well as painting the retail investors as the bad guy losers who are trying to take down the financial system or hedge funds for that matter. And probably one of the biggest misinterpreted thing is regarding restricted trading on brokerage platforms such as Robinhood and Webull. And the main reason that it allegedly happened is they claimed that it was due to liquidity issues. For example, if you execute a trade, let's say if you buy or sell GameStop, although Robinhood shows that the trade executed, the trade just moves on to this thing called the Clearinghouse, where the trades are eventually actually settled between the buyer and the seller, which normally takes up to 2 days. Now, during this settlement period of up to 2 days, these clearinghouses require brokerage platforms like Robinhood to actually have money as collateral or as deposit in case the settlement doesn't get 100% fulfilled, because they're scared or they're worried that these investors don't have the actual funds in their pockets. Now, typically the collateral or the deposit requirement from clearinghouses to Robinhood is manageable. However, due to the increase in volatility across GameStop as well as AMC shares, these clearinghouses upped their minimum deposit requirement, where Robinhood explained that they required 10x more than they originally did for these particular companies. And since Robinhood doesn't have the liquidity or the funds in order to put down this collateral or deposit, they essentially restricted trading to stop from going bankrupt, which a brokerage platform going bankrupt is a whole nother issue that we're not going to go into this video, and how it can really disrupt the entire financial system as we know it. And just to be clear, I'm not defending Robinhood at all. I think what they did restricting trading during these critical periods is ridiculous, and they are getting sued right now for doing this and imposing this. However, I do think that there needs to be some bigger change from the regulatory level to prevent this from happening again and prevent these brokerage platforms from potentially going bankrupt from these clearinghouses requesting more liquidity. And actually what we've seen come out on Friday is the SEC came out and said that they're going to start investigating into this, looking into brokerage platforms that have limited customers' ability to trade. Now, whether or not something comes out of this, no one actually knows. We know that the politicians or some of the politicians are on our side, but keep in mind, Wall Street is not on our side, and they're probably going to do everything that they can in order to get their way. So now, what do we expect to happen this week regarding the infinity squeeze? And make sure you stay until the end, because I'm going to bring up a scenario that literally no one else is talking about that I think people should start being concerned of. And just to start off, we'll bring it back to the original point that Melvin Capital claimed they exited all their short positions. Now, just because they claim it doesn't mean they actually did it. In fact, if we actually look into third-party data from S3 Partners, we can see that GME short interest is now at $11.2 billion, where 57.83 million shares are shorted, or 113.31% short interest of the actual float. What this means is that the actual short interest hasn't really budged and is still over 100% of the actual public float available. So the question is, will the squeeze happen this week? And my answer is maybe. And I'm saying maybe because I think the squeeze has already been happening the past week. Well, mostly for older shorts. And when I say the older shorts, I'm referring to the shorts that have shorted GameStop a long while ago and have been bleeding a ton of money as the stock has skyrocketed the past couple of weeks. And I specify this because I think the older shorts shorts are covering, however, new shorts are entering the game. For example, after GameStop reached $150, new hedge funds came in and said this can't possibly go higher, so they short the stock. After GameStop reached $200, new hedge funds came in and said this can't possibly go higher, so they short the stock. And yada and so on to $300, $400, and $500, etc. So essentially, I think what's happening is a continuous level of new shorts entering the game and trying to short GameStop. And this really plays into the scenario of what we're seeing regarding the current events, where S3 data shows that their shorts are still over 100%, as well as Melvin Capital claiming to have exited out all their short position. They could have just opened new shorts on GameStop and closed their original old shorts, as well as other hedge funds coming in and shorting GameStop. And honestly, that's just a guess right now. However, what we do know for certainty is that 57.83 million shares are still shorted out of the available 50 million shares in public float. Now keep in mind, retail investors own about 16% of the available shares, which brings us to retail investors controlling around only 8 million shares. And the rest of the shares are owned by institutional investors such as Fidelity, Vanguard, and BlackRock, etc. So now I'm thinking is, will hedge funds start reaching out to these institutional investors in order to get them to offload some of their shares to cover their short positions? And really it can go two ways. The first level of thinking is thinking the institutional investors like Fidelity, Vanguard, they have all to gain and nothing to lose from holding on to these positions and waiting for the stock price to continuously increase, because ultimately that would benefit them and their holding position. Now the second level of thinking is that Vanguard, Fidelity, BlackRock could offload these shares, take in a very nice capital gains, and redeploy this capital on elsewhere in the market when we realize that the entire market is on sale right now. Now keep in mind, if Fidelity, BlackRock, Vanguard, these institutional investors do start offloading their shares for these hedge funds, then we can actually track this by checking out the volume every single hour, because more likely than not, they're going to be offloading millions and millions of share at any given moment, where the hedge funds will be scooping it up. So we're going to see a huge spike in the volume traded, as well as beginning to start to squeeze and driving the price up higher. Now, the beauty here is in the details, because even if the institutional investors offload their shares, there aren't enough shares public for them to cover their entire short position, because keep in mind, they shorted more than the actual shares available in the market. And the only way to get out of this situation, assuming nothing changes, is these hedge funds continue to buy GameStop, they return it, they continue to rebuy with losses at every single step of the way, and thus the infinity squeeze. And I want to emphasize if nothing changes, because there is one scenario that I'm a little bit concerned about that no one else is bringing up that we'll get into in just a few minutes. However, regardless of how this plays out, just remember that time is on our side and not the hedge funds, assuming everyone continues to hold and assuming nothing external factors changes. According to S3 Analytics, hedge funds have lost around $20 billion on GameStop so far this month alone. Other reports saying that hedge funds have lost 15 to 20% of their assets so far, so what we know is that they are bleeding right now. Essentially, every single day that these hedge funds do not cover their short positions, they are bleeding, and the squeeze is more likely going to come, because it's costing them money in fees and interest rates in order to actually short these stocks to cover off these borrowed expenses. And honestly, these hedge funds have a lot of capital, so we might expect the stock to go sideways for a little bit. And I mean sideways relative to what the 700-800% spike, sideways meaning that it'll still stay within the range and be very volatile for the next couple of days. And the reason for this is because the hedge funds want to hold out as long as possible, waiting and expecting for retail investors or someone else to start cracking and start selling off their shares. However, if they start realizing that day after day and everyone continues to hold, then pressure is going to start mounting, opportunity cost is going to start increasing. In an ideal scenario, they'll start running out of money, or they're expecting that they're running out of capital too quickly. And from there, they'll start needing to cover their short positions and thus driving GME stock price up. And once one hedge fund breaks, the price is going to start increasing, which is going to break the other shorts and the other hedge funds. Another scenario that we're hoping for is this thing called a margin call, where essentially these brokers that these hedge funds borrowed these shares from, this GameStop shares, actually calls them back. Essentially, they might come out and say, okay, we see you don't have enough cash in your account, and to reduce volatility or complete risk of you not being able to pay, we're going to demand more cash, or we're going to demand you to return these GameStop shares. And the hope here is if enough institutional investors get margin called, then they're going to have to start purchasing GameStop shares, thus driving the stock price up. And really, that's what we're hoping for this week, in that the hedge funds start covering their short positions, and or the brokers calling in their margins, and thus potentially sending the stock price parabolic. And in a few minutes, I'll just show you some indications on how you can determine when we are actually in the middle of the massive squeeze. But in reality, no one actually knows when the squeeze is going to happen. It could happen on Monday, it could happen on Tuesday, it could happen next week. It's dependent on a ton of different factors, such as retail investors, will they continue to hold? What will Fidelity, Vanguard, BlackRock do? Will regulators step in, etc., etc.? But there is one thing we can expect this week, and that is continually the hedge funds will continue to come in, send up press releases, doing bot posting to ultimately distract retail investors, paint retail investors as the bad guys, continue conversations with Fidelity, Vanguard, BlackRock, and ultimately make you try to think that the price is going up substantially, causing you to sell your shares, or that the stock price is going to go down substantially, causing you to sell your shares at a loss or a gain. And one scenario that could happen that I think would damper this entire movement is if GameStop comes out and start issuing more shares. Because if they do a share offering, then that's ultimately going to help the hedge funds because they can scoop up these shares at a discount. They already have a $100 million offering lined up. I think they initiated in December. So the question now becomes, will they realistically offer even more shares and take advantage of this opportunity where the stock price is completely out of the water? And honestly, no one really knows. At the end of the day, GameStop is a business, and the main purpose of a business is to make money. They are in the middle of a huge transition period, and they might want to have some cash on hand in order to continue to move forward with their expansion goals. But it would come at the expense of all the retail investors that believed in GameStop, and they would have to realize the fact that they're actually helping the hedge funds by effectively bailing them out, who were initially trying to undermine their entire position and didn't believe in them even existing. So just take this into account. I'm not saying it's going to happen, but I'm also not saying that it can never happen. It's another risk factor that people aren't really discussing. And I think the more information we have and the more clarity that we have, the better conversations we can have about GameStop, about the infinity squeeze, etc. And finally, one of the best indicators to determine if we are currently in the massive squeeze or not is to continuously track the short interest. Essentially, if we continue to see the short interest to drop under that 100% threshold, and we continuously see that short interest getting smaller and smaller, then that is potentially an indication that the massive short squeeze is happening, and off we are to the moon. And again, just to clarify, I am not a financial advisor. This is for entertainment purposes only. This is not investing advice, and you should definitely do your own due diligence. Now, if you want to see another stock that might interest you in a long-term hold, check out this video over here, or check out this video over here.